So with this VLRT framework, like what is the prime objective for you when you're actually managing the public money?
Perspective of Warren Buffett is very different from what people think at. Now when we talk about long term, why long term? I call it a lazy style of money management. Because in long term, if you make mistakes, it's average out and hidden. But if you manage your money better in short term and medium term, you not only protect your downside, you generate alpha out of it.
The things that we are taught to be very cautious about are the very things that are driving the performance at Quant. Do you factor in that unknown risk, which even data cannot capture?
Okay. So we are style agnostic, market cap agnostic, thesis agnostic, completely no thesis. We are pure opportunity. Where I will get superior risk-adjusted opportunity, I will play that.
Can you give me some difference between the momentum and your style? Hi, I'm Satya Sontanam from Zerodha Varsity. Welcome to the 9th episode of Know Your Fund Manager series. In this episode, we have Mr. Sandeep Tandon, the Chief Investment Officer of the Quant Mutual Fund. You must have heard that Quant Mutual Fund has grown significantly in the last few years, from managing a few hundred crores of investments to almost 95,000 crores of assets under management as of December 2024. I can say this episode is going to be very different compared to other episodes that you've heard so far about the styles of managing money. At Quant, the funds are driven by data analytics. Sandeep questions all the conventional wisdom that we have had about investing so far. He doesn't believe in buy and hold strategy. In his leadership, the fund house has developed its own proprietary framework, which is called VLRT Framework. It depends on valuation, liquidity, risk appetite, and timing. This is based on so many data points that the fund house collects, and that drives the investment philosophy of the fund house. While the funds come across as very volatile and very high-risk funds, Sandeep says that their prime objective is to manage the risk. I've asked him some very important questions and so many doubts and apprehensions that people have about funds of Quant. At the end of the day, you have to invest in what you believe and what you are comfortable with. Here are just his perspectives. And remember, this video is just about his investing styles and nothing more. Sandeep, thank you so much. Thanks for joining in our Know Your Fund Manager series. It's our pleasure. It's been most anticipated and asked episode to do. So yeah, here we are. Thank you so much for joining us.
Yeah, thanks for coming to our office.
Sandeep, my first question is, what are your views on Warren Buffett principles of investing?
So I tell you, Mr. Buffett is a great guy. We all acknowledge it. I think people have used him in the way they want it. Okay? It's a human psyche to take advantage of somebody who's very successful. So if you say, I'm a Warren Buffett fan, people acknowledge you. Okay? But I have a very different perspective about him. He has been labeled as a buy and hold, sit tight guy thesis. Okay? What I call it very lazy style of money management. Actually, Warren Buffett is not in that style. I think Warren Buffett is a guru of timing. He's the ultimate guru for us in market timing. If you really look at his timing, when he has bought the stock and when he exited, he's one of the phenomenal returns he has generated. I don't think he owns more than any stock more than 2 years. Okay, it's average number if you look at. So if you say he's a buy and hold guy, a long-term thesis guy, answer is clearly no. He's a great guy. Answer is yes. He's a great market timing guy. Yes. He's a great visionary. Yes. So our perspective of Warren Buffett is very different from what people think at.
But he also had some stocks, right, where he usually says, I look at companies as businesses. I don't look at it as stocks. And there are some companies where he bought and, took benefit of it, like Coke. He's invested it for a very long time.
But what is the percentage of his portfolio? It's very small amount. See, I tell you, sometimes we have to look at, people talk about success. It's a human psyche to talk about. Everybody I've seen on media comes and talk about their success, what they got it right. How many people talk about their failures? The success is 2%. Okay, 98% is failure globally. Okay, so if you don't talk about your failure, then I think you're not doing justice with yourself. Okay, then you are hiding behind something which is not correct. It's very important to analyze your failure also. Like we very proudly say, Quant has been built after mistakes. The whole idea is that we should not repeat the same mistake. As a human being, we will make mistakes, but we'll ensure that we should not repeat the same mistake, and then you are more successful.
Got it. Yeah, I mean, I asked that question because Quant MF appears to have actually defied so many, principles that we've learned from Warren Buffett. Maybe I can enumerate 5 things that comes to my mind. The first is long-term approach, as you also mentioned. We all learned and believed that buy and hold strategy works. The second is fundamentals. I understand that Quant also gives importance to fundamentals, but not in the reading annual report kind of a thing, or like typical fundamental research kind of a thing. The third is the style. When you look at Warren Buffett also, even he says that he's actually, evolved from being a pure value investor to, value at reasonable price. And there are so many fund houses which bucket themselves as a growth or value, or even like GARP, growth at reasonable price. But with Quant, that's not there. I mean, you have VLRT framework, which you've developed by yourself. We'll get to that later. But the other 2 things that we as finance writers also learned are, timing in the market is very difficult, so we shouldn't do it. The next is also the volatility. In fact, when we assess the funds, we see the funds which have lower volatility. But the things that we are taught to be very cautious about are the very things that are driving the performance at Quant. Now I'm in a dilemma. Is it that what we have learned is inefficient and wrong? Or is it that what we've learned didn't work for you and you have chosen something for yourself?
So let me break some myths.
Yeah.
Okay. First of all, long term. Okay. I always say investor is long term, asset class is long term, equity and asset class is long term. Sector and stocks are not long term. But we have been taught certain stocks are blue chip. What blue chip? Okay. If you go analyze what was the Sensex so-called blue chip portfolio, today maybe more than 50% of the company don't exist. Okay. Hardly 3-4 names which are the part of 92 census are still in the Nifty or in the large cap. They don't even exist. Some of the companies are even small cap. Okay. Or they have to unwind it. So it's a very important myth to break. See, what is important long term? Let's understand. We look at everything from a risk perspective.
Yeah.
As a risk manager, we always say we are in the business of risk management. Returns are byproduct. Don't chase your return. Manage your risk. If risk you manage, alpha will be automatically generated. Now, when we talk about long term, why long term? I call it a lazy style of money management. Because in long term, if you make mistakes, it's average out and hidden. But if you manage your money better in short term and medium term, you not only protect your downside, you generate alpha out of it. So it's a combination. See, like how we look at needs. You can't say that I have everything of you have short term, medium term and long term needs. You can't say my short term needs also I will fulfill in long term. You can't tell your spouse I will take you to the holiday after 5 years. Let me save first. Or let's go out for let's say for a restaurant after 6 months. Let me save. So your needs are different. So the way we understand individual needs, that's the reason we always try to know what is the risk appetite of that particular investor and what is the investment horizon. Okay, and that's the reason we try to diversify. So when you look at the quant, everything is not long term. If even let's say small cap, mid cap who are long term horizon funds, only 70% stocks are identified from long term. 30% are also taken from medium term and short term perspective also. Because I have to generate alpha in short term, because let's say long term cycle is great, and whatever reason long term cycle is not performing. So your short term and medium term returns will also go. If I have 30-40% portfolio which is linked towards small let's say short term and medium term, I will still generate alpha out of it. So it's very important to understand this myth. I call it very strong word. It's a myth about long term. Now, buy and hold strategy, yes, it will only work if you are in the emerging stage. Like when you from infancy stage to growth stage, you come in the business cycle. That's the time buy and hold strategy. So when India was evolving and emerging, it was the buy and hold strategy will work beautifully. But when you reach a developed stage, or you have reached a stage of developed market, then buy and hold strategy will not work. So we call it ourselves as an unconstrained fund house. We believe in a concept of adaptive asset allocation. Okay, or in very simple terms, we try to adapt the market which is prevailing. We need to understand what is happening in the market and adopt your portfolio accordingly. You can't have a same strategy for every type of environment. Like look at, if you go and talk to any CEO and businessman, based on the market dynamics, he or she will adjust the sales growth, focus, or whatever product they are looking at, they will make variant, they'll make changes because environment has changed. You can't say that this is my strategy. I am a let's say some people say I'm a growth investor, I'm a value investor, growth at any price, I'm a techie. Okay, so what happened? All these type of theses have certain cycles. Let's say in 2012-13 onwards, when bull run started in India till August 2012, growth at any price did very well. So all the player who was practicing growth at any price were outliers.
Right.
2013 till 2018. Now, or 2021 to be precise. September 21, that cycle peaked out and value cycle came back. So all the people who have performed extraordinary in this phase are underperforming today. Okay. So now that cycle is gone. So we are saying we are style agnostic, market cap agnostic, thesis agnostic, completely no thesis. We are pure opportunity. Where I will get I superior risk adjusted opportunity, I will play that. That's the way dynamic style of money management work. We are not static style of money management. World is changed. We live in a dynamic world. Data points are changing every day. We all acknowledge. But you can't say that I will not change my portfolio because I'm a long-term guy. If something has changed, I have to rebalance my portfolio dynamically. That's the reason we bring a concept of dynamic rebalancing. Okay. And sometimes we have taught rebalancing. If you do frequently rebalancing, somebody says churn is high. Churn is a very bad term. Globally, there's nothing like churn. It's a rebalancing concept. Private equity rebalance portfolio in sometime in 10 years, sometime in 5 years. Long-term guys, they rebalance their portfolio yearly. Some people, hedge fund rebalance quarterly. A trader rebalance their portfolio daily basis. This need is different. Now you can't say, okay, I am a long-term guy, so I will not churn. Churn is very bad. No, we generate alpha out of it. If it's a risk-on environment, my portfolio has to be different. Last few months has been risk-on, my portfolio has to be different. If you don't look at from a risk perspective and just look at from a one style, because that style you have been taught or you have been practicing, you have been very successful. So you believe that is the best strategy. And then you talk about that. And that's the way the mistake comes into picture. That's the reason we say we are unconstrained fund house. When you talked about, we all have grown with this thesis of buy and hold. Even I have grown with that thesis. It took for me for 10 years to unwind that. Because in 2018, 2008, I realized all those theses didn't work. Okay. That's the reason we go and analyze the cycles. We try to identify the inflection points in the market. When you look at something extreme is happening. Those inflection point moments are very important. If you miss out those inflection points, you miss out big alpha.
So you've started with this conventional way of investing, but deviated when you figured by yourself that it is not working for you.
Yes.
Got it. And why don't you also tell a bit about your background, Sandeep? Because it helps viewers also understand why you've actually deviated. Is it because you've experience in the broking industry, or because you dabbled in the derivatives for a long time that made you lean towards this style of investing?
If you really look at my own background, I came in the market in peak of the cycle of Harshad Mehta, 92, 93. This was the peak of Harshad Mehta, like I call it euphoric phase. So far, we have not seen the repetition of that euphoric phase till now. Though we have seen, I will not use the word euphoric, is also a very diluted word. I will say maniac. So 92, 93, that was the maniac phase. Okay. And then after maniac, there's a euphoria, and then whatever other terminology you can use it. So when I came to the market, I felt that everything was extraordinary. 80 rupees thing has become 1800. Okay. And people, at the time, the number of people participants used to be very limited. Okay, very few people got an opportunity to milk that opportunity, which came for few months or rather few quarters. So I felt something unusual in that period, and that's the reason I exited all my position. When I say what my family portfolio, which is very tiny in today's context. Okay, so I came to the market at the peak of the cycle, and I sold. And that's the way my journey started. So I always looked that phase as a very important, and that puzzle was always there in mind. How can we quantify this euphoria, or can we quantify this madness in the market which is there through mathematically? not through feel factor. You can feel it. Can you quantify it? That's the way the genesis of quant come into picture. Then I came to the market. I have seen in those days Badla market. So I was very important player in those days and used to play in the Badla market. Okay, Jhotka, Fatka. A lot of people don't even understand.
Yeah, yeah.
Indian Badla market was very unique. From there is we learned the how to interpret those Badla rates
What is
or Badla
Badla
rates,
market?
like forward market, okay, future options market. It's our own unique way, okay. So we understand another chapter of behavior thesis, demystify the number and try to say what Badla rates are telling you about the market. Whether market is extremely positive or something, somebody is trapped when you have Unda Badla or some other terminology. In very simple terms, I'm trying to explain you. That's another important lesson to learn about human psyche. Market, these numbers are reflecting the sentiments of the market in some way or other. Okay. Then I was very early participant in the derivative market because the background was very good. I understand. So we was very successful. So I was one of the very early player in the derivative market and a very sizable player in the market. So another, again, human aspect. So that's the way the genesis of quant come into picture, that we quantify everything, qualitative, quantitative and behavior. Fundamental is your, what you people call it fundamental, for me is a valuation analytics. Okay, what do you look at? The liquidity analytics and that's the sentiments. So we call it fundamental atma, liquidity, the prana, and sentiment, the maya. This is a nice way. This is a nice way we explain. Liquidity is your lifeline. This is Brahma, Vishnu, Mahesh in that simple terms. If somebody wants to explain me, that's the way life is all about. Unless you practice these things. Now you raise another important point about fundamental, and fundamental. So this is another important myth. Because somebody says, I'm a fundamental guy. Oh, they did trade. They are chartists. They are so-and-so. They are macro guys. No. Everything in life is fundamental. We have taught wrong thing about fundamental. What market refer to fundamental is valuation. Okay. They only practice valuation. So when you live in a dynamic world, we practice dynamic style of money management through, if I have to call it, multi-dimensional models. When you look at valuation, valuation is important. It's like backbone. Okay. Without valuation, nothing works.
The PE you mean, right?
Or any sort of valuation metrics you look at, okay, cash flow base or whatever number you want to look at. But if you say that for me, valuation is 90% of everything, then it's a very one dimension you're looking at. Okay. So we bring second dimension of liquidity because liquidity is lifeline. Okay. Let's say COVID episode happened. Let me explain you very nicely. When COVID episode happened, what got changed? Market collapsed. It's anything fundamentally got changed. Even it got changed, people have not understood. People felt it was few months phenomena or few years phenomena, few quarter. Nobody has a clue about it. Okay, everybody felt market has become very attractive, but risk appetite collapsed. People didn't have guts to buy anything because we all were worried about our own life.
Right.
Forget markets.
Yeah.
Okay. So when your risk appetite is very low, okay, and liquidity was also low because buying, selling completely disappeared and the impact cost in the market was very high. And if you are a pure fundamental guy or so-called valuation analytics guy, you will feel nothing has changed. I will say veterans came in the media and said, what has changed? Nothing has changed. I'm a long-term guy. I'm holding for maybe a decadal view, few decades view, or few quarters view. For me, nothing has changed. First of all, that thesis itself is wrong. It has changed. You have not understood because nobody can visualize the next 4 years rural economy will collapse. Okay. So all these, the ramification you felt later. But what collapsed that day? Risk appetite collapse, liquidity collapse. So if I look at multi-dimension, I realize that something has changed. At that moment, liquidity and risk appetite was the most important dynamics for me. So in our VLRT framework or whatever number we look at, 90% weightage was given only to these two dimensions, liquidity analytics as well as the sentiment, which is the risk appetite. Over a period of time, so first, let's say till March or April to September, market rallied. Nobody has a clue about fundamental. And what answer you got? Oh, this is liquidity driven rally, tsunami of liquidity. This is the best money managers and veterans had told you. It's a liquidity driven rally. So we have not, nobody has taught about liquidity. We have only talked about valuation. We have never given the importance of liquidity analytics.
Yeah, valuation, that's when the principle of buy the dips will come into picture.
But liquidity is very, it's lifeline. If you don't understand, so what changed? And say liquidity has changed. Sentiment, which was very, very low, started improving. So liquidity analytics and your sentiment analytics, if I had to call it, was the driving force. Okay. Let's look at, this was the situation in March, April 2020. Come September 2021, when we took that big call on the new age stocks and said that this cycle has peaked out. What got changed? Valuation was all stretched. Okay, liquidity was shrinking, risk appetite was also drifting down. Okay, so liquidity is peaked out, risk appetite peaked out, valuation peaked out. All three dimension or multi-dimension, you look at these three dimension is an important one at the peak of the cycle, and as we says that market has potential to correct from here and growth cycle. And when you dissect this euphoria, where was the euphoria? Euphoria was the new age companies, euphoria was in tech stocks, euphoria was in the global market. There was no euphoria in the value stock, there was no euphoria in the emerging market, and hence the cycle changed. So we moved our portfolio entirely from growth focused portfolio to value. After a few years, growth underperformed, value outperformed. So it's very important to understand. Let's talk about what happened in India 2024. We turned cautious in July 2024. Okay, why? Because risk appetite for India was started drifting down. It's an important dimension. We turned cautious. We were ahead of the curve in being cautious. Come September, India liquidity also started shrinking. A lot of money got started shifting towards China. Now you say valuation was what has changed? Not much. So, but the risk appetite, which is a macro data, which is derived from macro data, was early to spot that the slowdown which you see now. So we took a conscious call in July if something is not right. Sometimes it is very difficult to quantify what is wrong. But we can, with the help of, if we can quantify known risk by saying something is not right. When you combine multiple data points, when you look at one variable, you don't get answers. When you bring multiple, that's the reason we practice multivariance model.
Say suppose you've been right. You looked at the data and you realized that something is going to happen. And you could be right. But we also heard that in market, irrationality could be for a longer period of time. Yeah. So how will you deal with that then? I mean...
So I'll ask, that's the way the fourth dimension of our work comes into picture, timing. So timing, since you also raised this thing, we have been taught nobody can time the market. Timing is bad. You should not time the market. Time in the market is important. I agree, time in the market is important. It talks about your experience. But timing is everything. As a student of management, we have been taught right place, right time. If you are late in launching a product and competition ahead, you are late. Nobody talks about failure. So you have actually failed in your assignment. Because we have been taught timing is a bad term, please don't use it in your analysis. Never talk about timing. Always talk about timing. Never talk about timing. No, timing is such a deep-rooted thing. We are very vocal about timing is a mathematical tool. Timing is a risk analytic for us. So timing is a function of liquidity analytics. Timing is a function of valuation analytics. Timing is a function of risk appetite. So timing is the analytics tool for us. It's a risk mitigation tool. And that's the way we groom our own colleagues out here. And this is what I have learned. Timing is everything. We write very boldly, timing is everything. And
so say suppose this is a hypothetical situation. I'm sure you would have covered this in your formula or the process, but for the benefit of our understanding. Say suppose the process or the data is showing that go for high beta stocks, like go and invest in high beta stocks. High beta is nothing but, for the benefit of viewers, high beta is nothing but when the market is going up, the particular stock will go up higher. When the market is falling, the particular stock will fall much more far more than that. Now say suppose all the data is showing that you have to go and buy the high beta stocks, but there is this unknown factor like COVID can happen and the whole system can collapse. And since you are holding the high beta stocks, the fall in the performance of the fund could also be very, very drastic. So how do you actually, I'm asking this question to understand how do you factor in that unknown risk, even which even data cannot capture?
So unknown risk, nobody can factor. Nobody can forecast an unknown risk. Okay. But if you really ask me, COVID was unknown risk in September, October 2019. Okay. In April, June 2020, it was a known risk. Okay. When it's early stages of COVID was there, and we have seen the spread out in China already happened. Okay. So it was not an unknown risk. A lot of smart people have already taken some precautionary step. Obviously, nobody knows the intensity of COVID at that point in time. That I agree. See, what is very important to understand when we say in a risk on period, when we look at the data and we say it's a risk off or risk on. So in risk on period, we play on front foot. Okay. And obviously, unknown risk nobody can quantify. Okay. But the strength of a money manager comes how he or she manages a unknown risk also. Okay. When perceived risk becomes known or unknown, how to manage unknown risk is also very important. You can't say that, oh, it happened, let's wait for time. Time will tell. We have a good quality names. I will wait for, even it takes 1 or 2 years, let me sit tight. No, that's not the way we do it. Okay. It's a evolving form, evolving data points, and if something is changing, we will reassess our portfolio. It's not something I have to rebalance on day one. Because sometime day one answer you don't get, because it's a one-day phenomena or it's a few days phenomena, we don't know when unknown risk hit you. As unknown risk becomes known risk to you. And that was unknown risk till yesterday. Today is a known risk, it's already happened. Now, if it is a known risk, then we get into what could be the intensity of this and what could be the implications of this risk. Once you assess that, then you can change your portfolio because it's no more unknown risk. So it's a very, again, important myth. Say unknown risk. Yes, it was till yesterday unknown risk. Today is a reality, na? So please adjust your portfolio.
So with this VLRT framework, like what is the prime objective for you when you're actually managing the public money?
So the prime objective, see, when you manage your individual money in the perspective, I am not answerable to anybody. It's my money. I can hold it for a decadal view. A lot of people like how private equity can hold for a decadal perspective. Okay. Because they are interested in long-term bets. So out of 10 stock, let's say they're in portfolio, and out of 10, only 3 are very successful and which can multiply and 7 fail. That model is right. Because 3 can give you multi-beggars. They can become 10 times, 100 times, 1,000 times. Once you manage public money, you can't take this approach. Okay. I will look at a combination. Medium term, short term. So I will look at, and when I design my portfolio, I will design my portfolio in such a manner that I have from a risk perspective, high risk, medium risk and low risk. My entire portfolio will be classified in this manner. Then I also have near term, short term, medium term and long term and decadal view in my portfolio. So some stock we buy for decadal perspective also. Let's say example, a wine industry, something is changing. There is early stages in life. Their market share is going to rise. So those stocks or those particular things like how green energy today. Green energy, we all know, is a decadal story. It's just beginning by 2032 or 33. Whatever changes we are making, India will emerge as a significant player in the renewable, particularly in the green energy side. So it's a decadal view. You can't take a call on those stocks. So, but you can't keep 100% portfolio in a decadal view. So it can be few percentage. So we look at diversification from the duration and the risk also. Then I able to balance it out in a better manner. That's the way we manage public money. I always say, manage risk, don't chase the returns. The problem starts when you start chasing returns.
When you talk about risk management, when you talked about the primary objective of the fund house and the VLRT framework is the risk management. But Sandeep, as you know, people in the finance who are looking at the mutual funds, for us, the volatility comes in these risk ratios. Okay. When you are talking about mitigating risk as one of the main objectives of the fund house, do you say that the volatility or the standard deviation, which shows that quant funds are at the highest level when it comes to standard deviation, is it not the risk, that standard deviation?
Another important myth. if you just measure standard deviation, then 8 standard kid will tell you what is the risk in the portfolio, correct? Because by 8 standard, nowadays 6 to 8 standard, they know the deviation. Ultimately, deviation can be positive, deviation can be negative. If it is so simple to say that risk standard deviation express the entire risk framework, then it's a bogus thesis, okay? We say that make volatility as your best, this invisible animal called volatility as your best friend. If you start understanding volatility, then you can play the game right, okay? So it's very important to understand risk, and you don't have to look at just volatility in isolation. You can't look at P in isolation. If some company has return ratio, high ROEC or high ROE or high free cash flow, by default, the valuation will be high. If you say that only I look at the valuation, isolation has no meaning. The matrix has to be complete. You have to look at both the dimensions. And hence, you have to look at risk-adjusted returns. What risk I have taken and what returns I have generated. If somebody look at pure risk number like standard deviation, which is outdated number for me, in isolation, it doesn't work. If you look at Sharpe ratio or Sortino ratio, Jensen alpha, or there are many risk-adjusted returns, those are the thing is a better. So if our standard deviation as a quant fund may be high, but our risk-adjusted return is the highest in the industry. And that's what you have to look at as an investor, not standard deviation in isolation. Like how P in isolation has no value unless you have return ratios.
In this framework, talking about the framework segment, what kind of companies doesn't be part of your portfolio at all, even if the data says go for it?
Being in market for nearly 33 years, okay, we have understood certain characteristic of certain stocks, certain sector and certain promoters, okay. So we do keep that aspect at the back of the mind. Let's say something is changing and something is qualifying in your data, and you know these are the risk of the past, or these are something which is not visible to us, because in this country you have innovative accountants also who keep on doing lot of innovation which is not easily captured, even the forensic also, okay. But you know the characteristic of such people being old in the market. So we do channel checks, okay. Sometimes channel checks gives you a better answer where the balance sheet or numbers may not be endorsing anything like that. So those are the channel checks are also very important, which is very key for our debt market investment. But as a process, we do for equity also. But if something you have to take a very small bet in your portfolio, you're not bothered too much about it, okay?
Sandeep, before we go on to the next segment, I also want to ask about the 2 dogs that are roaming in your office. Here we have one and there's one outside. What are their names?
Her name is Xenia.
Okay.
She's 11 and a half years old.
Okay.
And younger one is Zoya, one year plus now.
Okay, this seems to be the calmer one and that seems to be a hyperactive one.
Yeah, they're part of family. So my daughter described, we have 2 more siblings.
Okay. I think in Sandeep's terminology, this is the risk off dog and the other one is the risk on dog.
Yeah, my team also calls that the younger one is a small cap analyst and this is mid cap analyst, because they are part of all the meetings.
Nice.
So we say next term, they might be your bosses, because they are observing everything. Every meeting they participate.
I think they're also, indulging in the philosophy of the fund house. Nice. Moving on, with respect to, since we're also talking about the risk factor, every style, when we are talking about the growth value or the GARP style or whatever the momentum, contrarian, every style has its ups and downs. We know that, by now all our viewers understand that not every style will perform or outperform in every market cycle. When it comes to your framework, is there any market cycle that it outperforms or underperforms that you have noticed?
So, yes, strategy can outperform and underperform from a very... let's talk about underperformance. Yes, it can underperform in certain scenario, but that is a part of a strategy. Okay, we always say generate extraordinary alpha in risk on period. Okay, so when risk on comes, if you see the gaps between us and competition is very, very large.
So risk on period is the bull market?
Bull market. And because in risk on period, you can do stock rotation, sector rotation fast and keep on generating alpha. But as the risk off period comes, overall activities comes down. The impact cost is very large. So in risk off period, we say lie low, just protect your capital. Even in risk off period, you might underperform. but you have such a massive outperformance in the past that doesn't matter if you're underperforming. So sometime in a risk-off period, underperformance is part of strategy.
Can you give me some difference between the momentum and your style? Because you're also seeing that, okay, this sector or this particular stocks may move up, and then you're actually moving from one.
So yes, so momentum is a byproduct of price movement. When price rallies, okay, typically it's a byproduct of that. When price keeps on rising, okay, then people are chasing the momentum, and this is the phenomena not only at our end but globally. People chase momentum. I tell you, 90% people are momentum chaser. Okay, whatever name you want to call it, but if you sit down and analyze their style, mathematically or statically, we can demonstrate that they chase momentum. Majority of the people chase momentum. I'm using the word majority globally, not only in India.
Majority of the fund managers
Just chase momentum globally. It's a hard fact of life. Okay, but we do chase momentum. Sometime answer is yes. In a risk-on period, I will chase momentum. Answer is yes. But in risk-off period, no. So as a house, we are not momentum specialists. We are buyer and seller at extreme inflection points. Okay, like today, if you look at, so many stocks are at the neglected territories. If they have not hit the, let's say, hated zone, they are neglected. So I'm a buyer on these names and selling all the names which are either in normal territory or any name if I get in the most admired territory. Okay, those are the names we prune down and cut down. So basically what we are doing, I'm improving my risk adjusted returns. So at every higher levels I'm exiting, and every lower levels I'm buyer in some of the neglected territory. Okay, now this thesis is unique to us. This is the way we defined, because we are able to mathematically quantify. So we have ways of calculating the euphoria indicator, let's say a quant euphoria, quant capitulation, or quant bearish base indicator, or quant hype indicator. Lot of data point we have built mathematically, we can quantify. The advantage is that when you do this sort of analysis, when you build this sort of analytics, they're built in normal environment. Today, let's say we're sitting in a cozy environment and we can talk. If market is collapsing, that's the time you say, I will do some innovation, I will create something, it will not happen. Okay, rather at that moment, I will use the expertise which we have built over a period of time.
Yeah, I remember you saying that, build the processes when you are sane, to use it when you're not.
So when you have a crisis, okay, that's the moment I will optimize it. Rather than saying that now let's develop something. And that's the time you have to implement that. So these are the things which has been developed in a normal environment and are best used.
Right. So moving on, my brother has a Tesla car in the US. Sorry for my poor analogy, but he has this option of self-drive car. So though it is good, it is actually driving very well. In fact, there are also reports that say that by using the self-drive, the accidents could be far, far less. But still, there is a tendency to hold the, a wheel. We, in the fund house also, you believe in data, but to what extent do you believe in data? And to what extent do you also use your wisdom manually instead of completely depending on the data?
So it's a good question. A lot of people get confused with us, like we are algo house, we run algos. We don't run. Okay, we have done in our previous avatar when you should run our advisory and broking business or the prop business. Yes, we use high frequency data. Okay. But all the analytics which we build, the final call is taken by money managers. So machines don't take. Machines are our support system. They are efficient research assistant, if I have to call it. Okay, they help us in processing data fast. Okay, but they don't take calls. They will throw up scenarios. Okay, and they will give you some, let's say 10 examples. These are 10 names you can choose. A money manager perspective based on his or her wisdom, because everything cannot be quantified. Okay, today let's say some global new development has happened. Okay, have anybody imagine a scenario where interest rates can be negative, where cost of carry was negative? Even crude, you have to pay to get it free, but crude was available free, but you have to look at the delivery charges. Okay, and there was a situation where people are willing to pay you also, please lift it. Those are scenarios which we have never taught. So similarly in real life, all these new scenarios keep on emerging. It is the wisdom of a particular money manager how he or she will react. Okay, because machine can be built or any analytics can be built based on the history it has. If something new is happening, which has never been coded or defined, then how come machine will take a decision? That's the way the blunder and mistakes happen when you run only through technology. Okay, and then what we call it a typical algorithms, okay, or factor-based model, people run it. We don't do that.
Because it is a very unconventional way of managing the fund, we see a lot of critics also on this. I mean, people, I don't say critic, but people who doubt whether this will work out in the long run or not. I have a couple of points which people usually say in the analysis of the funds. Maybe a one-word answer, or what you think about it. You already touched upon it, which is higher standard deviation. Yeah, your answer would be that
in isolation, don't look at. You have to look at risk-adjusted numbers rather than just looking at the risk number. It has no value if you look at only one parameter, and standard deviation is one of the parameters, it's not the parameter. Okay, when you look at, if I said if risk is so easy to understand by standard deviation, then we don't need risk managers. Okay, you can't quantify these things. Standard deviation does not give answers. It is one of the parameters. It's a deviation only. Deviation can be positive. So why only negative? Why should it look at the negative context? Deviation gives me positive returns also, na?
A few people think that they do not want to allocate funds to quant because they think that the system is too complex to understand.
So first of all, any new thing comes, okay, we are trying to create a number-centric organization, data-centric. The hard fact is that we call it predictive analytics. In today's world, people use AI, ML, okay, we are AI and ML or ML enabled fund house, okay. So I think analytic is the buzzword. Analytic is not only in the market, any business, we always tell, educate your kids in the analytics side. That is the future, okay. If we all have accepted AI is the future, then quant is the best position to capitalize. We have been building so-called AI, which we call it predictive analytics. If I have to implement, we are the first person to implement AI things out here because we have been groomed in this manner. Okay, so what we call it predictive in today's world, you call it AI. We have been using it for last 30 years. So it's not something which we build. 33 years we have built this thing, and last 15, 18 years we have invested very sizable money. We have invested $24 million in building these analytics. So it's not something it just happened like that. Okay, I think we believe in data and data is God. So we don't want to change this thesis. We are doing irrespective of our hard work, whatever is required, irrespective of critics.
Again, this has been answered already, but frequent churn, maybe one word answer. That's the nature of the fund, you say?
No, nature, no. Churn is defined in a different way. Churn has negative connotation in India. In a portfolio management word, there is no word like churn. There's a term called portfolio rebalancing. Okay, as I explained earlier, it's a mindset of a money manager. Since we believe and environment is dynamic, and hence my portfolio rebalancing is also dynamic. So we write dynamic rebalancing. Somebody says high churn, doesn't matter. Okay, if churn, so-called perceived word churn, can reduce my risk, then churn is good. Churn reduces the risk of my portfolio, then churn is very healthy actually. And this is a myth which says that we should break this thing, because these are traditional way of looking at. So I call it very classic, lazy way of doing things. You don't want to change with time. You will become irrelevant. That's the reason I respect US money managers. They adapt much faster than emerging markets. We are still living in that era. This is the way we have groomed, and this is what we have been taught for last many years. If you don't change with time, then we also become irrelevant.
Before we go ahead, Sandeep, I'm really intrigued to know you have an engineering background. I'm intrigued to know how you build such systems or developed such interest in data analytics. You talk about predictive analytics and a lot of things. How did you develop such interest and skill to build such systems?
See, first of all, obviously I have a mathematics and management background. But what is very important, I think education and degrees are, I think it's just for the sake of say, you can say that, obviously it helps. But I think it's a very individualistic thing, So I was right from my childhood, very curious guy. We used to make electronic gadgets at the age of 6th standard, okay. We used to make transmitter, and we used to modulate create our own voice, used to make electronic gadgets like parameter equalizer, graph equalizer, TVs in very early stages, 7 standard, 8 standard, 12 standard, So that anxiety was there of creating something on your own. So that is the background. When I look back into some data, let's say you read a a nice book, you will admire and then you will forget it, correct? If I read something and if I like it, I'll go back and test it. Okay, something who's talked about US market, how it has really worked. It is just only a statement written, because sometimes people do write something and I can tell you most of the times the things are not correct. Okay, because the writer is also taken a particular time frame, a small period. But if sometimes we do get something out of that. So it's the interest which you go back and we try to reverse engineering and try to see and backtest these things, whether this has been effective. Then if you are a mathematical mindset, then we understand global macro. So interlinkages of these asset classes helps you to form some opinions about it. So I think it's just a curiosity element, nothing more than that.
Moving on, coming to the doubts or some of the critics, it says it's high concentration in some of the funds, high concentration bets.
Let's understand high concentration comes from conviction. And conviction comes from data analytics. Okay, so it is good to have a concentrated portfolio. That is a sign of an active money manager. I don't want to classify ourselves as a passive manager or quasi-passive manager. Today I take active management fees, so we deliver active product. If you look at majority of the houses, most of the people will mimic the indices. 70-80% will be index mimicking. 20% is the extra outperformance which will create through small cap or mid cap. That is not the case. That's the reason, if you ask me, why active manager have failed globally and passive has come up. Okay, the money manager, that passive has grown. Okay, now the challenge of passive is very different. Passive is when your risk appetite is high, liquidity is high, you will make money. Okay, when this cycle reverses, then active money managers will outperform the passive, irrespective of the cost. So for us, active money manager is the way. If I'm saying that, let's say next decade belongs, it's going to be very challenging, then I think active money manager will perform better than the passive. And we strongly believe that we manage active money in active manner and what we call a dynamic style of money management.
The next one is about having high overlap between funds within the quant.
So it's a good question. First of all, when we design a portfolio, particular scheme, I don't design a portfolio keeping in mind that one investor will put money in all my 27 schemes or 24 equity schemes. Okay, that particular portfolio is designed keeping, let's say example, flexi cap. If a flexi cap portfolio is designed, it keeps in the aspect how well I will balance based on the risk on risk of environment between small, mid and large. If as a house, we think particular stock has highest potential and it is already allocated in different fund and I should not allocate, is not fair. Okay, the difference is that, let's say that particular stock is a large cap. So by default, the weightage of that particular stock in the large cap will be the highest. In the flexi cap, it can be second highest because it is a, let's say, a risk off period. My weightage towards large cap is skewed. It can be there, but in mid and small, the weightage may be very small. Okay, so based on the SIT requirement, the stock can be overlap, but not necessarily the weightages. That's the first point. Strong believer, unwarranted diversification mathematically is bad. Unwarranted, like you don't get it's like sector skewness is there right now. Particular sectors are doing better and or of an inflection point thesis showing this is a cycle time to buy some sector which is bottoming out and you are not there, then you land up in chasing it at higher price. So obviously it means this is not a great strategy from a risk adjusted returns. Our objective is what? To generate superior risk adjusted returns. At any given time, returns are important. At what risk I'm taking that return, that is important for me.
The other one is, as the size keeps growing, because the fund repeatedly buys and sells stocks, it would be difficult as the size of the funds grow.
So this is another important myth. Okay. Why I say so? US is a very classic example. The size of the market has grown up so multiple times. And globally, here we have $10 billion fund or 12 billion thing is a very big size. People have $50 billion, trillions of dollar funds are there. Few funds are more than $1 trillion. They don't find it difficult. Okay, so it's a myth. Let's understand from Indian market point of view. As we are growing, or let's say our AUM is also growing, the depth and the breadth of the capital market is also rising. Number of issues which is coming to the market, number of stocks qualifying for the, let's say, indices stocks or the F&O basket, or maybe market cap perspective, liquidity perspective, it has increasing. So I'm not growing in isolation. It's not saying my AUM is only rising and market is not growing. Okay, we get new opportunity IBS market, we get through block, private equity, divestments. So I think India, if I have to say, economic activity is just gathering momentum. Just imagine 3,000 crores, 3,000 IPOs are being lined up in next few years.
So when there are so many variables, is there a higher probability of something going wrong?
So as I was explaining you, if you are dependent on one variable or few variables, then if those variables are not working for whatever reason, let's say if you are only dependent on valuation analytics and valuation become expensive and you are looking at pure, then the problem starts for you, because you think market is becoming expensive and you are pruning down, raising cash level, market is not correcting. Where when we run, let's say, a complex multivariance model, okay, then the probability of skewness of few data actually goes away. Where I'm talking about thousands of data points, when multiple data points are skewed on one side, I take aggressive bets. When we are not getting any skewness, I will lie low. No need to be very aggressive at that time. Sometimes aggression doesn't pay. Sometimes we also say you can take 2 steps backward also. Okay, it's not necessary that every time you have to move on. Okay, you have to take risk and you have to keep on climbing. No. Sometimes consolidation is also very important. Okay, so time consolidation or correction, whatever market calls, is a healthy thing. So multivariance model is a far better way of calculating, if I have to say, the probability of being successful is much more in this model and less risk.
Now, coming to the next question, which is about running the fund house. I mean, from outside, it looks like as if you're a one-man show. I mean, of course, there are great fund managers within the fund house, but it looks like the entire system is dependent on you. So what's the key man risk policy here?
It's a good question, but you look at what we write tagline, multi-asset, multi-manager. First point. It means there are multiple managers. Today I'm in the phase because for various reasons our board has authorized me that first 5 years you will be the face of the organization. It's a strategy. And it's not with us. Many mutual fund, you will see very limited names coming out. But they are backed by institutions, so you don't see a key man risk. Globally, money managers, institutions are not very successful in money management business. It is, money managers is already individual thing, okay? Still, we have a large team, large process around that. You have seen what last 1 year we have hired so many senior people in the system, right? From the CEO is joining, okay? CFO has come, process auditor has come, chief compliance officer, internal control has come. Many hiring has been done. Okay, and it's a process. See, the challenge is that we have grown very fast beyond our own expectation. So sometimes it takes time, but we are not in a hurry just for the sake of hiring that we'll hire anybody. Okay, but if you really look at the scalability of our business. So team which was managing 27 crores, the same team managed one can look at the scalability of the business. It means we have strong processes around that. It's not dependent on one person as you perceive. Okay, it was dependent on one person, then we could have not managed 1 lakh crore what we are managing today. We could have been exhausted at 10,000 crore itself, which is not the case. It means the processes are very strong. Okay, and when we say tagline multi-asset, multi-manager, it means the dependence on me is also not there. I said there is no value of my own views in my own company. Okay, and we are creating an institution. See, it's always when you look at any institution, whether it's Goldman which got built or Kotak which got built or HDFC, let's take example in India, some of the institution got built. Okay, it got built over a period of time. Okay, I have worked some of these names, and even I was part of the Goldman in the past, the Kotak in the system, or even ICICI or HDFC. They're large institution, but started today. If you talk about HDFC, is Deepak Parekh or Aditya Puri. But today, they both have retired. Look at the institution which is created. My previous boss, Mr. Uday Kotak, he created a phenomenal institution. Today, he's also retired. Look at the legacy. So I think it's always start with few individuals and then it's just get built. So we are also in that phase that institution is getting created. Okay, so you have to be patient for that.
Understand. So far, we've talked about a lot of things that you are doing, things that worked, but can you tell few specific things that didn't really work for you or for the fund house? Mistakes.
So I tell you, we are very candid people. I always say Quant has been built, the genesis of Quant is mistakes. We have learned from our mistakes and that's the way we describe us. And we keep on learning from mistakes. So if you say that we have arrived in light, answer is big no. And any given time, we always say we are 28% time always wrong. So one way of saying that 72% time always right.
Yeah.
I will start saying that 28% time we as a house is always wrong. If I get it 100% right, then we have a God status, which nobody has in the world. Okay. So 72% time we get it right, 28% by default we are wrong. Okay. Now, the problem will come if this 28% time, if you are wrong virtually at the peak of the cycle or bottom of the cycle, then you have a problem.
Yeah.
Okay. And that's the way the risk management things come. Rather, we have been very successful in the extreme inflection points. So we get those extreme inflection points right. Sometime in between phase, let's say today's phase, the market is not going either way anywhere, Those are the challenging moments. Okay. Where data points are not very decisive. Okay. Neither you can take very aggressive bet, nor you can take very defensive bet. What you will do. So the face of the market, those are time which become very frustrating sometime. But that's the way I always say in risk of lie low. Lying low is better strategy rather than making mistakes.
Got it. Moving on to the fourth segment, Sandeep, there are 5 funds which are like the top 5 as per the AUM also. Why don't you just talk about, maybe a word or so about these funds like Quant Small Cap, ELSS, Active, Mid Cap and the Flexi Cap funds?
So I think what is very interesting is that all these, if you look at the 3 years and 5 years track record, I then look at 5-10 years track record, all 5 funds are leader in that 5 years track record. Okay. And that's the reason you say, if you are long-term investor, then you have to long-term cycle. Don't look at 1 year, 6 months, 12 months okay. A lot of people have that comparison. Oh, previously it is 6 months you are underperforming. 1 year, obviously if 1 quarter you underperform, you are down in 6 months also, you're down in 1 year also. But it may not affect your 5-year returns. So what is very important to understand, all these funds, had done extremely well. For me, it's not about outperformance or absolute number. For me, what is important is the risk-adjusted returns. As a house, we always say that our risk-adjusted returns are the best in this product. Now, all these products are run in a very unique manner. Okay. Now, let's say small cap, which is one of the largest AUM which we have, about 27,000 crores we manage. It was 40 lakhs fund in 2020. Okay, and I think we take away one of the largest share in this space, okay, on month basis. What is uniquely we did, in risk on time, we were 99% small cap. Okay, in risk off period, which is the case in last many months, we are running even 30% large cap. Okay, in risk on period, we are running high beta and low liquid stock also because they run.
I think that's why there is a question also that why is reliance in small cap?
Correct. So in risk, so what we did when we spotted in, let's say in last many months is a risk off period in July, we said, what we did, we moved from high beta to low beta, we moved from illiquid to liquid, and we increased the weightage of large cap versus mid cap or small cap in our portfolio. Okay, it's a part of a strategy because it's a risk off period. Now, whatever reason, let's say small cap has still performed very well. So if you have changed your strategy, you bound to underperform a bit. But based on the environment, we have taken a precautionary aspect. It's like, people sometimes don't understand risk. So let me explain. Like in Bombay, you get rainy season between 10 June to 10 September. Okay. It's a monsoon season. People do take precautions. People do carry umbrella because we know this is a monsoon season. So if I can foresee it's a risk off period, I will take precaution.
But now, the timing has been slightly preponed. I mean, earlier.
No, yes. So it is always good to have early. If you are late, then you may not. So you cannot time it. So like 10 June is where generally monsoon forecast is. Sometime it becomes 6 June, sometime it becomes 21 June, sometime it started in July also. Okay, so you can't time it that perfectly. But what is very important, if I get a risk of sense, it is our moral responsibility and a fiduciary responsibility to readjust your portfolio. Don't take unwarranted risk. Like a lot of people make fun. Today monsoon forecast is there. Today, like in Bombay, we say orange alert or yellow alert or red alert. Okay, and today's a lot of critics will say today will be going to be dry day.
Yeah.
Okay, today nothing. Let's work against the Met department maybe they may be right. Now I am not a person who will take that call, because Met department is also based on scientific data on the pressure points and the speed of the wind speed and other thing. They are forecasting this could be a wet period. Now, I am not going to challenge that period, because they are the best and they are forecasting. They are doing for hundreds of years this part. Okay. So, I will follow. That's the reason, as a risk manager, if my data is saying is a risk of period, I will lie low. उस समय शिवाजी नहीं बनना है. That's the way एक candid गर्दन कट सकती है. Okay. If does not happen, that does not mean you got it right. Okay. So as a money manager, I will play it safe.
Do you say this is the reason why it has slightly underperformed in the last 1 year?
Because we have taken a conscious call, and now mid-November we said mild risk. From a risk off, we said mild risk on. I have still not used the word aggressive risk on. Mid of the month, and you saw minor improvement, still not very major improvement. So we use the word mild. So, and we are slave of data. If data will change, we can become very aggressive. If data deteriorates, we can again become very cautious.
Thanks. That's all, Sandeep. Thanks for so much patiently answering my questions. I think the dog has also been bored and she just left. But finally, how do you invest your own money? Where do you invest?
So obviously now it's a mutual fund is the best tax efficient vehicle. In the past, I used to invest on my own. But from 2015 onwards, it's all about a mutual fund, and my 100% capital as of now is in our own mutual fund.
Nice. So, and how do you spend time outside work? I mean, do you have enough time outside work?
So you met two dogs. I
Yeah.
spend good amount of time with them. Music is a hobby.
Okay.
Socializing is also a hobby, but with like-minded people.
Okay. Who do you hang out with for markets? Any known names?
I don't want to pinpoint any specific name, because all are very dear friends. So market is very small. We know each other quite well. Okay. So we do meet, we do interact, because I always believe by interacting with people, I do learn a lot. Okay. Because I have my own perspective and my own environment, my own surrounding. Somebody else has grown in a different surrounding and different environment, and their perspective is very different from me. It's very good to have interaction and get their perspective. And that's the way we always say.
Lastly, what is your way of giving back to the society?
One way of giving back to the society through this route itself, I'm generating betting alpha for them and generating wealth for them. Second thing is also about educating them. How world has changed. Please don't live in that era of buy and hold. That thesis, that era is over. Change yourself. The way asset classes have changed, let's say crypto has emerged, a new asset class emerged, it's very important to understand the importance of asset allocation, and it's very equally important to remain very agile and very dynamic. The way you think, you also have to change yourself. You can't say I've given it for 10 years perspective, 20 years perspective, I'll review after 10 years. No, you have to review your portfolio every 3 years, every 5 years. So accordingly, if something is not performing, you have to change how we look at our portfolio. If something is not working, whatever reasons, then we have to rebalance. So it's very important. Otherwise, what happens, a lot of people have this thesis is a long term. Okay. And it becomes very core holding type. The non-performers becomes long term. So all performers fund or performer stocks will move out from your portfolio, and non-performers becomes your core portfolio, which initially you feel happy one day it will perform, but over a period of time you realize this is the biggest mistake you have done. And hence, review of portfolios is equally important. People have to give time to assess on continuous basis their needs, because as they are becoming old, their needs are also changing. Okay, so it's very important to continuously evaluate the process. I'm not saying every month, every year, But 3 to 5 year perspective, you do have to evaluate.
Got it. That's all from my side,
Thanks a lot.
Sandeep. Thank you so
And
much for
thanks for
joining
coming.
us. Thank you.
Thanks, you guys.